I really wanted to touch base with us today. Want to go over strategizing into 2023. What are some of the different things that I personally anticipate is things that we are going to see within the market, things that we are going to anticipate. There's obviously a lot of different talks, a lot of different expectations in terms of the market, a lot of different analysis of exactly what it is that we want to kind of cover. So I will be sharing this thereafter here. Um, but please feel free to ask any of your questions in the meantime while we kind of go over this, and then we'll take it from there. Okay. So again, just kind of to formally introduce myself. Again, for those of you guys who don't know me or are watching this later, my name is Abdel Khawatmi. I'm a licensed mortgage loan originator. Been doing this for quite some time now, seeing a little bit of a different market from pre-pandemic to during the pandemic to post-pandemic. We've obviously seen from a little bit of a shift from that little bit of a neutral market, buyer's market, to seller's market for the last 2 years, and then obviously to where it's been now in that dramatic shift. So, kind of going over exactly that, we're going to cover what are a lot of the different tips, a lot of the different avenues of what my personal recommendations are, and then we'll kind of take it from there. Again, I did get a chance to share the link with you guys in here. Should be able to click on it and copy paste it. If you can't, regardless, I will share it after this with this recording and kind of discuss what are some of the different tips and recommendations that I have on that as well. Okay. So, kind of starting out with the first thing, what I want to touch on is in reference to the Fed. The Fed is the Federal Reserve. Their stance over the last couple of months, really even a year now, has been they were looking to tame inflation. We're going to go over extensively what inflation is. We're going to cover also a strong job market. Most of us have been seeing, obviously, on the news, some big companies, such as Amazon and bigger companies, are laying off in the masses, right? Amazon just laid off, I believe it was about 18,000 employees and some other employees as well, extensively. So, what does this basically do? So, one of the main things that the Fed did say was they were going to continue hiking their federal funds rate. So, what's the federal funds rate? The federal funds rate is not the same as mortgage rates. The federal funds rate is rates that consistently are done with banks borrow the money from them. So, it's the overnight borrowing of money from banks. Okay. And what they do is they've been consistently increasing that since November of 2020. And what happened in November of 2020 is they announced that they were going to start tapering. And tapering means that they were going to slow down the buyback of mortgage bonds. Okay. And that's exactly what happened. And since then, interest rates have been excessively on the rise. Okay. So, another thing that we also want to look at is something called CPI. So, CPI is what is called the Consumer Price Index. The Consumer Price Index is what is measured in order for us to see how much consumers are spending every single month. Okay. So these readings are always a month back, if that makes sense. So the reading that we got in December was from November. And those readings for both the months of October and the month of November were really good. It showed that inflation was slowing down. Last month's reading was 7.1% in terms of inflation. Right before that, in October, was 7.7. The new inflation report data for CPI is actually going to be coming out this Thursday. So on Thursday, we're going to get the new reading specifically for CPI, which is a very big data point that I think is going to give us an idea even further of what we think the Federal Reserve's stance are. So for those of you guys that are slowly jumping on, please feel free to answer any questions that you guys have. Again, we are covering what my personal projections are in terms of the market, some of the common trends that we're seeing, and really why inflation's been that really difficult bully, I should say, to kind of push away. So then we also want to cover home sales. So we went over inflation, specifically the stance of the Fed. We went over CPI. Again, guys, that's a consumer price index that measures how people are spending their money. And then we also look at home sales. So obviously, we know that home sales has been slowing down. There's a reduction of mortgage applications, but also to keep in mind, it's counteracting with mortgage rates. So mortgage rates were a little bit on the rise over the last couple of days, and I mean Thursday, Friday, and then today, the market has actually experienced a big positive impact for rates, meaning rates have actually dropped by almost 30 to 40 basis points. I think when the market closed today, closed at 6.17% last time I checked it. That was essentially the benchmark. And that was the lowest it's been since September. So we're obviously making positive grounds in terms of rates, and home sales happens to be one of them. Once the Fed starts noticing that the market is running into one of the lowest it's been, which when it comes to home sales it has, they will start to be a little bit subcautious in terms of hiking or reducing their benchmark. Okay. Then we also take a look at home prices. So, of course, we all know that home prices was a big impact in terms of them for the pandemic. It jumped up significantly, right? We all saw that appreciation jumped up in some areas 15 to 20%, okay, year over year. What we're seeing right now, although home prices are dropping month over month, they are still 9.2% higher than they were in October. That is not something that we normally see with the Fed, right? Or I should say in the media. The media, obviously, generally tends to do what? The media tends to always focus on, I would say, some of the negatives for clicks and media, whatever their intentions are. But that's a point that I look at where although the annual reading's declining, we're still seeing a 10.7% gain in terms of home prices. So that's a big one. Okay. And they're still projecting with Case Shiller that home prices are still going to increase by 3% next uh, next year. So we went over dramatic increases, and then we're still going to see small increases, not as big, but we're seeing that. Employment, we obviously just kind of briefly covered. When it comes to employment, again, what we've reported, we have seen job losses actually rose by 225,000 claims. And that was as of the end of December 24th. We'll get a new reading also again. I believe they actually just updated it too. Today, they corrected it. But again, on a positive note, we are seeing that create a impact in terms of how the Fed stances be. And I think that's really why the rates have been moving when I had mentioned to you guys earlier in that positive direction for the last 2-3 days is because that job employment report came out. And you guys, like I had said, the Fed is looking to hike their Fed funds rate with really no regard to interest rates. And they said that we don't care, basically, in frank, how people are going to be losing their jobs. Inflation is what they are looking to target. I believe it was about 5.5% is what they want to hit that wage employment. Yeah. So unemployment rate right now is 3.5%, and that goal that they want to hit is 5.5. Now, we are going to start seeing a lot of that friendly data that I was talking about in terms of CPI, in terms of inflation. So now this new thing that we start hearing a lot about, which is wage impact. So obviously, when the cost of stuff goes up, we want people's money to also be made more as well. So we will monitor wage growth and kind of see how that simultaneously impacts us as well. Okay. So if wage growths do increase significantly, then that's a good thing. Then the Fed will say we're in a positive route, although we do it. So right now, again, we're going to kind of see that if the Fed does consistently keep raising the cost of borrowing money, is that really going to put a lot of different companies to have no choice but to lay people off? Or are we going to see them kind of shift that focus and hopefully kind of realize that they've done their part? So again, guys, a lot of information, but this takes time. So for those of you guys who are following the PowerPoint or will follow it after, this takes time. This is not a click, turn the button off, and we're good to go, right? It takes time. Remember, we're counteracting almost basically 2 years of a super busy market, right? where during COVID, we were lending at such a small amount, such a cheap amount. And then, of course, we were printing, I think it's about 40% of the current economy from treasuries. We were printing it within the last 2 years. So, of course, this is going to create a dramatic impact. And we were literally just printing with numerous stimulus checks. The cost of borrowing money was so low because, again, investors were simultaneously a little cautious about that. So we ran into a lot of different aspects of what those informations were happening. So I think we're starting to get the bad end of that. Last year, 2022, was certainly a unique year. You know, it was basically two different markets that we went through. The end of 2022 was a little bit difficult, and then the beginning of 2022, volume was still crazy. So now buyers, on the other hand, we're going to kind of go over how it's basically becoming a chess match between buyers and sellers. Okay. So we went through inflation. We went through a lot of those avenues in terms of business. We went through business growth, wage growth, unemployment, and then simultaneously we saw we're going to look at CPIs, and hopefully this Thursday we'll get that friendly CPI data reading as well. Now, what are programs that we have to look out for? Okay. This is a big one. I think that these four are going to be very popular programs that a lot of clients are going to want to take advantage of as we start gearing this year. And I'm already seeing them. The first one is the FHA 203K loan. So FHA is the Federal Housing Administration. They have a special program called a 203K, like kite, 203K loan. And that is specifically a construction style loan. So it is one mortgage. You qualify for the home of the value of what's called the ARV, which is the after repair value. So what happens is that you check out a house, whether it's distressed or maybe needs a little bit of a facelift or not livable or whatever the case may be. Of course, inventory right now is kind of shifting to all different types of homes, whether it's move-in key ready, whether it's homes that need that facelift, whether it's homes that are just distressed, people didn't pay their mortgage, they didn't upkeep the premise, so on and so forth. We're going to see a lot of that. For those who are watching, whether you're a client or an agent, don't get deterred from those type of properties. Those are definitely the type of properties that you want to keep an eye out for within this market, okay? Because those are the type of properties that you're going to have in probably fairly easier time to get. Still super competitive, to be honest. You know, in some urban areas, Hudson County, Essex County, and New Jersey, you know, you're still bidding over asking. You're still going over that, which we're going to kind of go over in a few. But again, specifically 203K, you're allowed to purchase a home for the value and finance the repairs. What happens is that a contractor goes to the property, checks it out, gives us something called a bid. There's two different types of 203Ks. If you spend under 30,000 or more than 30,000, most of the times clients generally spend more than 30,000 between the kitchen and all that stuff. And we get a HUD consultant who goes there, matches with what the contractor says. We do the appraiser, they match, so on and so forth. Okay. So I think that's going to be a very common program that is going to start going around. Okay. And then we also have something called the NJHMFA, which is the New Jersey Housing Mortgage Finance Agency Down Payment Assistance Program. Okay. They just increased it in certain counties where you can actually qualify for $15,000, which can be used towards your down payment or closing costs. Some other counties are $10,000. If you guys want more information, please feel free to let me know. But they did change it. $15,000 that you can receive in down payment assistance. Now, you do have to qualify. It must be owner occupied. You can't have owned a home within the last 3 years. And there's other certain parameters. If you sell the house early within 5 years, every single year thereafter, it drops where you have to pay it back. First year 15, then 10, then 5, and so on and so forth. Okay. So then what we're also starting to see are called non-QM products, which is basically non-qualified mortgages. Those clients who either don't want to go through a full documentation style loan, where there's special programs like a bank statement loan program where you could do a 12-month bank statement loan. Let's say you necessarily write off a lot on your taxes and so on and so forth. We don't even need to see your taxes. Credit score is a factor, but we would take a look at your 12-month of filings for your gross sales, and then we would simultaneously work our way backwards based off of your deposits and your withdrawals and calculate your income from there. That's a great program. Then there's also something called a DSCR loan, which is a debt service coverage ratio loan. This is becoming very popular. Again, guys, a majority of these programs are generally for specifically for DSCRs, non-owner occupied investment style programs. So the DSCR, what we actually take is the rental value of the potential home, and then we use that. That's the only thing we generally need to see if you can qualify for the specific mortgage program. Credit is a factor for the client. We do it in an LLC and all that fun stuff. Okay. Then we're also going to see, I'm already seeing it actually, non-warrantable condos. So there's a lot of different condos. So when you're purchasing a condo, not only do you as the client have to qualify for the home, but the condo association themselves simultaneously also have to qualify as well in order to be able to proceed. So we take a look at delinquencies, we take a look at the number of percentage of ownerships and all that fun stuff. Okay. Now, a lot of the times, some of these associations may have a lawsuit against them because we check that as well. If they do, or they have a high delinquency, or the percentage of ownership exceeds the minimum thresholds of what's called Fannie Mae and Freddie Mac, which I could talk hours for that, which I won't. But if you do, then it's non-warrantable, meaning you have to get these special type of programs in order to be able to qualify for the home. It doesn't even have anything to do with the client. It's specifically geared for the property. Now, the client has to qualify traditionally, but that kind of allows you to circumvent some of those delinquencies and stuff. Okay. And then the fourth and last program I think that's really popular, we could still do them today, but it's called the Freddie Mae Self-Employed One-Year Tax Return Program. So if you were a client who necessarily didn't make a lot of money in 2021 or filed a little less, taxes are right around the corner. I always recommend my clients use a trusted CPA or an accountant, but there's a special program that a lot of consumers have access to. If you're self-employed and you've owned the business specifically for 5 years, we can actually use last year's tax returns in order to qualify. So let's say, for example, you own the business for more than 5 years, you filed in 2020, 10 grand, and then you filed 90 in 2022, and you could show proof you've owned it, we can qualify you based off of 90. Now, of course, the end of 2022 just occurred. If you file that as well, we can simultaneously use it based off of what you file for 2022. Now, of course, we want to try to make it as a security caution that your P&L, your filings and all that stuff, your profit and loss match, and we take it from there. Kind of diving in really quickly, I did a home buying seminar not too long ago talking about what are the quick things that I look at for a client when we're trying to get pre-approved. So if you're a realtor or a homeowner looking to qualify a client or qualify yourselves, you want to keep these 4 things in mind, okay? And I'll go through them really quickly for the sake of time. Any person who has any questions, obviously, please feel free to message me. The first thing, it's called the 4 C's. The first thing is called capacity, which is what is your ability to repay the loan, okay? So that's also referred to as debt to income. So we take a look at what's your capacity to repay the loan. There's specific percentages for an FHA loan, 56%, conventional, 45%, sometimes 49%, but 45% is the sweet spot. Okay, so you want to do that percentage based off of your gross income if you're a W-2 employee and your net income if you are a self-employed employee. Okay, let's say you make 10 grand, 56%. The max you can qualify in total debt, which is your mortgage payment and your credit, is $5,600. So you can work your way backwards like that. Next is your capital. Capital is how much money you have in the bank. Where's your money coming from? It has to be seasoned. We have to know where it's coming from. If it's coming from stocks, 401k, savings account, we have to know where it's coming from. You're not allowed to have cash deposits. So you want to make sure that you're simultaneously having your money sourced. Money's coming from sources that you know where it's coming from, so you have access to it. Okay. And then we have collateral. Collateral is what the property you're purchasing for and exactly how much the property is currently worth. We basically always conduct an appraisal, right? We check on the appraisal. We make sure that it qualifies or appraises for what you're purchasing it for. A lot of people do these overbiddings, so collateral comes into play, depending on how you structure the offer. If you waive the appraisal for for a $400,000 home and you offered 425, you got to cover that $25,000 difference. Now there's strategic ways around it where you could keep it at 400, 425. You would just not cover as long as you were at the minimum LTV, which is loan to value. You keep an eye on that stuff. Okay. And then the last four C's is your credit. Credit, obviously, we all know when you're purchasing something is probably one of the most important things that you must have. You want to make sure that you're working with a trusted professional who can take a look at your credit. Some free websites out there, annualcreditreport.com. I do have the opportunity to qualify my clients off of a soft inquiry where we can actually run your credit, provide you with a formal pre-approval as well off of a soft inquiry. It does not affect your credit. Now, if you're a client who simultaneously has a little light credit and so on and so forth, I'll be more than happy to take a look at it for you, whether you do a soft inquiry or send me a copy of your credit report and give you some of my personal recommendations, whether it's being added as an authorized user, whether you're paying off some of your liabilities, which is about 30 to 35% of your credit score between your payment history and also your payment utilization. Okay, so you want to keep an eye on that because that's basically 60 to 65% of your credit score of the two. Now, strategizing here, these are some of the things. Again, the market's in that shift, but there's local markets here that are still super competitive. Okay, some recommendations we have our clients, again, if you really want the house, waiving the inspection, sometimes limiting it to environmental, structural, and foundational, waiving the appraisal or putting a cap on the appraisal or escalation clauses, offering larger upfront deposits is a big one. I tell my clients, if I gave you that pre-approval, we're more than likely good to go. Okay, so offering a larger deposit shows that you have a little bit of skin in the game. Structuring an offer above asking, so you and I would coordinate with your agent. We would work together to make sure that the comps, which is also known as the comparables, match. They're a little bit higher than what we're offering or kind of close to it. So we have an idea of exactly what is going to be the anticipation. And if the house underappraises, we don't just throw in the towel. I will simultaneously work on arguing the value of that and try to get us as close to the appraisal as possible. So again, not the end of the world when house is overappraised. There's always ways that we could try to structure it to make sure you have the best possible deal. Okay. Offering to pay transfer taxes, I do that, and sometimes on occasions if the client really wants a house. Generally in the state of New Jersey, sellers pay the transfer taxes. If you really want the house, that's an opportunity for you to do it. Understanding the seller's motivation is a big one too. If somebody passed away, obviously seller's motivation might be quick if they wanted to sell the home. If it's a seller who's lived in the house for a long time, they might have some personal heart to the home. I'm going to keep that in mind. Asking for personal property is a big one too. They left a jacuzzi or microwave or stoves or whatever it is. You sometimes want to avoid asking for personal properties. I've literally had deals. I'm sure some of the agents who are on have had deals where the deal died because they couldn't agree over a washer dryer to this day. So you want to keep an eye on, minimizing your requests for that type of stuff because it does kind of play an impact as well. And then also working with the right lender. So, of course, last one's going to be a little biased on my end, but you want to make sure that you're working with the right trusted professional who is going to educate you about your options, give you an understanding, not just give you a piece of paper. Guys, interest rate is not everything. It's important, but understanding your options, putting a little bit less, putting a little bit more, going conventional, going FHA, offering a very quick closing. My team and I have had success literally in closing deals in 7-8 days. Okay, so you want to make sure that you're working with a reputable lender who has a solid name, solid reputation, works with your agents, coordinates with all the professionals. I always tell my clients, working with the right professionals in many instances saves you a lot of money and headache than sometimes the house itself. And that is no joke. Okay, so that's super important for you to do. And then the second to last thing I'm going to cover is trends. So we're going to talk about heading into 2023. Now that we've geared into it, what are some of the trends? And I think first-time home buyers are slowly going to start coming out of what I call the woodworks with less bidding wars. Interest rates, as I had mentioned earlier on the call, are already shifting. Okay, they're already on a downward trend. I really predict if Thursday comes in on a super healthy report, it should continue thereafter. It's kind of that weird shift right now with employment, but it's on a positive level. So again, Home buyers is about 26%. Really predict that we're going to head into about 40% of the market in a healthy historical market, comprising of the number of buyers. So 40% of first-time home buyers. That's going to be a shift. Also, the amount of equity. Of course, like I had mentioned earlier, if you bought your house in 2017, 16, you're sitting on a lot of equity. Okay. Interest rates obviously might be about the same. 17 and 18, fives wasn't unreasonable. Sixes wasn't, it was a little high, but right there. But if you're a homeowner, you're sitting on a lot of equity. You want to make sure you're working with the right lender, whether it's doing a cash out refi for the entire thing or doing a HELOC. A lot of my clients, we do HELOCs. So HELOC is a home equity line of credit. So I wouldn't necessarily want you to refinance the entire amount if you have a 2% interest rate, 3% interest rate, 4% interest rate. Keep that at your principal balance, your first mortgage, and get a small HELOC, 50 grand, 100 grand, whatever it is, to pay off some credit card debt, go on vacation, whatever the case may be. Okay. Sometimes doing a cash out refi entirely may necessarily not make sense, especially when the market, projections are that they're going to slowly downshift. Even though the Fed doesn't change their mindset about hiking rates, remember that doesn't directly impact mortgage rates. It plays a role, but over the last few recessions, remember the housing market in a majority of them did really, really well. Okay. So, and then when we have that, we're going to see some homeowners who have that equity tend to renovate, tend to pull equity out, or do some type of things in order to stay in the homes. That's going to increase values for homes as well. And then the third trend that I predict is we're going to start seeing a lot of staging of homes, right? A lot of the times in 2020, 2021, sellers either kept it in the condition that they were at, or if it was vacant, the sellers just left the house vacant, right? And then you like the house. If you didn't like it, you didn't have time to turn your head. One of the trends that I predict in 2023, I'm already seeing it, is you're seeing a lot more homes start to get staged. So we're still seeing, till this day, home prices, if it's priced correctly, it's still super competitive. Super competitive, okay? Especially if you're in some certain local markets, houses are still getting multiple offers. Houses are still staying on the market, either quicker. The average homes that are staying on the market right now, statistically, is only about 21 days. Not that long, right? Some homes are staying a little bit further on the market, but again, we're going to, I think, start seeing a little bit more of that balance, like I said, between buyers and sellers. Sellers right now are a little bit more lenient to fix certain things for home. Sellers are a little bit more lenient to offer sellers concessions, which you can use to pay your closing costs, to get a lower interest rate by doing a buy down, pay discount points, and stuff like that. So if you're a buyer out there, not necessarily a bad time to purchase a home. It generally only is about what is your best options. Not the media, not the news. What is your personal scenario, your unique scenario, whether it's income, qualification? What is it that you are currently looking for? If you're looking for a multifamily home to help you offset some of the value of, or I should say, some of your payment, that's a great option. If you're a homeowner who wants to do that 203K that I had just mentioned to you guys, very common. We've got some awesome trusted professionals who are even on this call right now that are licensed contractors, investors themselves. So you want to make sure that you sit with a licensed professional and assess and game plan heading into 2023. The national news doesn't always pertain to you, right? California, from what I saw, happens to be one of the states, Santa Monica, some other areas, where they've actually experienced depreciation, where home values are actually diminishing. I can almost confidently tell you New Jersey is not one of those states. Certain areas of Florida are still booming. So you want to understand, sit down with that licensed professional, sit down with that realtor, game plan together, get an understanding specifically for you, what you're looking for, what do you need to do in order to put yourself in the best possible position to qualify. Quit paying your landlord's mortgage. You might pay a little bit more for a mortgage than renting, but it's yours. You own it. The appreciation of it is going to pay for itself. The value is going to appreciate for itself. The fact that you can put a nail in the wall, for some of us, that's awesome. The fact that you can just freely purchase whatever it is that you want. Those are a lot of the different things that you want to consider if purchasing a home is right for you. I wanted to stay right at that 30-minute mark. I hope this provided some value. I appreciate you guys giving me the chance. I will download this, if I can figure it out, and I will share this on all of my social media channels. If you guys have any questions, visit my website, gotmortgages.com. You can call me or text me personally directly, 201-679-0422, and it would honestly be my honor to help you. I appreciate you guys giving me the opportunity to spread some knowledge as we gear into what I predict to be a very, very busy 2023. Put yourselves in the best possible position to buy a house. We're going to start experiencing into end of first quarter. I think we're going to go back to bidding wars. We're going to go back to it being a little crazy. Put yourself in the best possible position to qualify. Be confident when you're checking out homes. Work with a trusted professional, whether it's me or anyone else. You want to make sure that you're working with somebody who truly cares about you and doesn't look at you as a dollar figure. It is so important for that. I can't continue to stress my professionals who I tell them, dude, pick up the phone, communicate with your clients. Clients are looking for comfort, clients are looking for knowledge. And that is something that I can confidently tell you that my team and I do very well. I appreciate you guys taking the time. Once again, I will share this information online. Chris, I appreciate you jumping on. Any questions that you guys have, give me a shout. Let's rock and roll. Let's make 2023 our year. Have a great day, guys.